Hello, good afternoon, good evening, wherever you are. This is another session we have on the strategic case study exam. As I've always said, I'm going to be giving you the lectures back to back so that you can easily pass your strategic case study exam. I'm excited to walk you through this journey and ensure that you pass your exam. So I always post lectures on this YouTube channel, and so if you haven't subscribed, please do so. Hit the notification bell or the bell icon so that anytime I post a video, you'll be the very first to get it. And you can also follow us on social media, right? You can follow us on social media on Facebook and Instagram. You can find us with the name Pinnacle Professional College. Pinnacle Professional College. So please take note of that. Now, today's objectives. Today, we are going to be looking at analyzing financial performance briefly, and then we'll talk about production strategy, HR strategy, etc. And we'll look at the marketing mix. This is one of the key models when it comes to the strategic case study exam. Then we'll be looking at information systems and information technology. If we have anything else that we would like to talk about, we certainly will. So first off, finance issues, you should know, are very, very relevant to strategic planning in two ways. A finance objective is normally the main corporate objective of a business entity, So usually the finance objective will essentially be the main corporate objective, even for, a non-profit entity, its main objective would be the availability of funds or the availability of finance. So that's how finance objectives are directly tied to strategic planning. The finance function also, the second way is that the finance function also within an entity provides a strategic support function to the entity's competitive strategy. So the finance function drives strategy by serving as a backbone or a support for the entity's competitive strategy. So those are the two ways. Now let's talk about financial performance and objectives. The finance function within an organization provides a system for setting performance targets and measuring actual results against the targets. So what was the implication of this? If you're able to set targets and compare to actual results, what's the implication? It allows management to monitor and control actual performance. It helps for monitoring and control. Once you know that these are your targets and this was the actual performance, you're able to do monitoring, and controlling in order to ensure that your performance meets your targets. If the entity uses what we call the balanced scorecard approach, which we've talked about in prior videos, so if you haven't looked at it, you can go and watch it. Performance should be measured against all the targets of performance that is defined in the balanced scorecard, which includes the financial objective, the internal process objective or perspective, which includes the customer perspective, which includes the learning and growth perspective. So these are four perspectives that the balanced scorecard looks at. We said that the balanced scorecard is not your traditional management accounting tool because it focuses on financial and non-financial objectives. Now let's talk about analyzing financial performance. The techniques and ratios that are used for analyzing financial performance should be familiar to you already, right? So there are a lot of techniques that we use. So we talk about, for instance, annual sales growth over a period of time, right? Annual sales growth. So how do we calculate annual sales growth? You know the sales growth in the previous year, and you're able to calculate the percentage growth or percentage decline in the sales. So sales growth may be divided into sales volume growth, that is sales quantity growth, and sales price growth. So two things can grow, the quantity or the price. Those two things affect sales. And you also have the gross profit ratio and the net profit ratio. We all know that the gross profit ratio is simply your gross profit over your sales. Your net profit ratio is your net profit over your sales. So basically, what those ratios is saying that for gross profit ratio is saying that for every dollar of sales or every CD of sales or every pound of sales, we are making X amount in terms of gross profits, right? So if the gross profit ratio for a company is 32%, what does it mean? It means that for every 100 CDs or every $100 of sales, only 32 goes to gross profit, or we only receive 32 CDs or $32 as gross profit. Very, very important. Same for net profit ratio. If the net profit ratio is 32%, that means that for every 100 dollars or CDs or pounds of sales, only 32 is actually net profit. It's only $32 or CDs that we receive as net profit. Very, very important. So these two ratios help you to understand how much, how much are you spending? How much is actually going to cost? So if your net profit and gross profit ratio is low, it means that your company is draining in terms of costs. The costs are high, and you might want to look at some form of cost rationalization program to ensure that you're able to cut costs down. Then you also have the ratio of expenses to sales revenue. The ratio of expenses to sales revenue. That's also possible. So for example, you can look at the ratio of marketing cost to sales revenue. Marketing cost is supposed to drive revenue. So sometimes you'd want to look at the effect of your marketing on sales. You can also look at the ratio of administration cost to sales revenue. They also have the total borrowings of the entity, which is measured as, could be measured as your financial gearing ratio, and the ratio of interest cost to sales revenue. So gearing, as we always know, the formula is debt over equity or debt over debt plus equity. It tells you how much debt, how leveraged, or the amount of debt you have in your capital structure. You also have the ratio of non-current assets to sales. Here, you are talking about how efficiently are non-current assets being used to generate sales. How efficiently are non-current assets being used to generate sales? So that's also a key ratio. You also have the ratio of inventory to sales, or the average inventory turnover time, which shows how efficiently inventory is being managed. How efficiently inventory is being managed. Then another one's like investments in innovation or R&D. What you need to remember about financial analysis and strategic analysis, you should always put your financial analysis into the context of business strategy. You should not just put numbers out there. If you say net profit ratio is 32%, what exactly does it mean? That's what we're talking about here. What exactly does it mean? So we are saying here that always try to put your financial analysis into the context of business strategy. So in particular, you should try to assess what the trends in the financial ratios might indicate. So for example, falling unit prices might be, a part of a strategy to increase market share, right? So sometimes when you're calculating your ratios, you see that maybe your sales is dropping. All your sales ratios are dropping. So what does it mean strategically? Let's place it within a strategic context. What does it mean? It could be that it's a strategy that management has deployed to decrease prices so that they can increase market share. So that's a typical example. The rate of growth in sales volume, profitability, and investment in R&D can all be indications of the current position of a product in its life cycle. For example, little or no growth in annual sales and high net profit margin could indicate that a product is in the maturity phase of its life cycle. So What these ratios actually, another thing you need to do is to place it within the context of the product life cycle. Is it in the introductory phase? Is it in the growth phase? Is it in the maturity phase? If it's in the maturity phase, for instance, you see that sales might be declining, profit margins will be declining, as we already indicated. If you haven't watched our lecture on product life cycle, please go and do so. Okay, now let's talk about resource allocation, funding and resource allocation. Another role of the finance function is to obtain the funding that the entity needs for the implementation of strategies. You need to know that organizations, need money to operate, need money to do the things that they have to do. So one of the roles of the finance function is to obtain the funding. They need obtain the finances so that the entity is able to implement strategies. Some entities might have a fixed amount of finance that it is prepared to invest. When there are many different investment opportunities competing for a limited amount of investment funds, the finance function then has to come in. So usually, as we all know, there would be limited funds that an organization, an entity will have. There will be very limited funds. And the investment opportunities would be many. There are lots of things you can invest in, but the funds you have are small. So the finance function comes in this way to be able to efficiently allocate resources. Efficient resource allocation is the role of the finance function. Very, very important. Now let's talk about the role of the accountant in business strategy. Accountants and the accounting function have some role in business strategy, but the extent of their involvement will depend to some extent on the attitude of the accountants and the attitude of the accountants within a business organization. So the attitude of the accountant is important. Now, what is the meaning of the attitude of the accountant? Traditionally, accountant has been, when we talk about accountant, it's people have this notion of, avoiding risk, taking the safe option. Those are the notions that go with being an accountant. But as we all know, successful business strategy depends on being entrepreneurial and taking risks. That's all about successful business strategy. You need to be entrepreneurial. You need to take risks. So traditionally, accountants have been associated with judging the merits of any investment on the basis of financial return. So, for example, if you have some new project you want to do and you take it to an accountant, their judgment is usually based on the financial return you are getting and the short-term profitability. They are only looking at the short term and they are only looking at the financial return. But, some projects have peripheral benefits or subsidiary benefits that the accountant might not necessarily capture because there are other non-financial factors that must be taken into consideration. If accountants are to be involved in business strategy, they need to accept the long-term nature of many strategic decisions and the difficulty of making reliable financial assessments. So what is the role of the accounting function in corporate strategy? They must provide systems for recording financial transactions and provide management information systems and the procedures for decision making. So they must, one, have that holistic view, when it comes to assessing or appraising projects, not only looking at the financial side of things, but the non-financial side. They must also provide that support for strategic decisions. All those things are the expectations of the today accountants. They must also assist colleagues or help colleagues in research and development and marketing with new product screening and decision about whether to develop and market a product. So the accountant of today, if he's going to play a role in business strategy, must be able to partner with other functions like the research and development function, like the marketing function, and be able to give insights when it comes to, developing and marketing products. They must also learn to work with marketing colleagues to assess the effectiveness of marketing initiatives and the marketing mix. So that's very, very important. Now let's talk about the research and development strategy. The research and development strategy. Innovation is necessary. As we all know, one of the things we know when it comes to Apple is innovation. So innovation is really, really necessary. And it's necessary for several reasons. Number one is product renewal, right? Product renewal. So product renewal is basically changing the design of a product, and that helps to prolong the life of the product. Many products therefore undergo design changes during their life in order to maintain or increase sales, so that you are doing it to renew the life of the product. Then you have product adaptation. This is where products are adapted to a new market segment. So for example, a product might be successfully marketed in Africa, and now you take the same product and you try to adapt that product to, let's say, the Asian market. So the example I give you is, for example, a product that is marketed successfully in the US might be adapted by its manufacturer for sale into Europe, where customer needs might be different. So that's product adaptation. It's all part of ways to innovate. Then you also have developing new technology. So from time to time, you develop new technology that becomes available and creates new way of doing things and opportunities for new products. And the last one, you have developing new products. This is where you're actually developing, creating new products that haven't existed before. And one thing that many new product ideas are unsuccessful. They're unsuccessful. However, when a new product is successful, the first firms to enter the market and develop their product will often be the market leaders. If you are successful with your product, you become a market leader. So these are the 4 ways innovation takes place. Number one, product renewal, which helps to prolong the life of the product. Product adaptation, which helps to, push the product into a new segment. Developing new technology, which helps to create a new way of doing things. And developing new products, which helps, an organization, if they become successful with a new product, to become a market leader in that field. Now let's look at R&D as a function. Some industries, business entities establish a research and development department with research labs, but R&D functions will usually exist in high technology industries, where the pace of technology is very, very fast. Things are moving fast, or where new product innovation is a major strategic objective. So in areas like the pharmaceuticals, you usually see the R&D function or the research and development function. Some industries do not need a research and development function. However, entities within these industries would have a way of developing new products. They might have their own product design teams in that case. Now let's talk about R&D strategy. R&D strategy. There are various issues to resolve in order to achieve successful innovation through R&D. A decision has to be made about how much should be spent on R&D each year. So before we go into the year, we need to understand how much are we spending on R&D. The need for R&D spending will vary between industries, obviously. If you look at some companies, their R&D expense is very high because they are the leading edge of scientific and technological development. Within the overall spending program for R&D, decisions must be made to allocate the spending between research and more specific project development. So how you allocate your research and development expenditure or budget is very, very important. R&D strategy must allow for failures. So you are researching and developing to bring something new, but it can certainly fail. Research might not lead to any specific product development. You must understand that you can research, and might not lead to anything. So you must make room for failures. Development projects too might fail as well. So always keep that in mind. So first off, you need to know how much you spend in the year. You need to make room for failures. Number 3, a large part of R&D spending, which is research and development spending, does not produce a financial return. And since much R&D spending is discretionary, it might be tempting to reduce R&D spending and invest more into established products and markets. You know, that's one of the big problems when it comes to research and development, right? You know, research and development spending does not necessarily produce a financial return. The products the things you are researching on in order to bring to the market might not work. So it does not guarantee a financial return. So there's a temptation to cut on research and development in order to save your P&L and rather use that money to invest in more established markets. However, in industries that are more reliant on innovation, you need to have research and development. It's core to their strategic objectives. Now, who is an intrapreneur and who is an entrepreneur? When a business entity is first established, innovation is provided by the entrepreneur, right? It's provided by the entrepreneur. In larger entities that have outgrown the entrepreneurial stage of their existence, there's no obvious role for them, entrepreneur. Its senior managers may be competent in many aspects of management, but do not necessarily have any talents for innovation or entrepreneurship. This means that there's a strategic risk. If a large entity does not have any entrepreneurs, but its competitors include smaller entrepreneurial entities, there's a risk that the entrepreneurial competitors will be more successful. So what are we saying here? So the entrepreneurs are basically the people who fuel the creation of a business entity. The people who fuel the creation of a business entity, people who start businesses, who create startups, you know. But who's an entrepreneur? An entrepreneur is someone within a large business entity who converts new product ideas into a finished product. They are inside organizations. They do not start companies, but they convert ideas, new product ideas into a profitable finished product by taking risks. So entrepreneurs are you can be working for a company and being an entrepreneur so far as you'll be able to bring ideas on board, and convert those ideas into finished products. Companies should therefore be able to try and identify individuals who are capable of being entrepreneurs and give them the authority and the resources to be able to come up with innovations and take risks. Now let's move on to production strategy. Now let's talk about capacity planning first. Capacity planning. You can't talk about production strategy without capacity planning. So let's talk about that first. A company that is planning to grow must have sufficient capacity. Growth stems from capacity. You can't grow beyond what you are capable of, handling. So growth comes out of capacity. You can't grow beyond your capacity, right? You can't grow beyond your capacity. So if you're a company, right, can your company, provide goods that will serve the entire Africa? If yes, then they have capacity for it. If no, then they don't have the capacity. So a company that is planning to grow must have sufficient capacity to meet the expected demand for its products. This means having sufficient production factories or plants. So you must have the factories or plants. Or it's possible that the company may plan to outsource the production of components, or even entire products to external producers. So that's capacity planning, right? You must have sufficient production factories, right, to be able to supply the whole of Africa or the whole of the United States with let's say, steel. Your production factory or production plant should be able to support that, should have that capacity for that. In planning the required production capacity, a decision should also be made about whether the company will set production levels to meet expected sales demand in each week, so that at times of high sales demand, production output is also increased. So you need to also think about your production strategy and your capacity planning, right? You need to match your production to your expected sales. So you always need to be checking out, what is the expected sales. So for example, you know that in Christmas season, getting to the end of the year, people buy a lot of things. So in that case, as a business that is proactive, you need to increase your production at those points to meet the expected demand. And when things are low, you also, you also rationalize your production in that regard. Another way is whether there should be a steady level of production output, right? So that in times when there are low demand, you build up a stock of inventory. So when there's low demand, you have inventory in the warehouse, and this inventory is used to meet sales, periods which have high demand. So two ways, right? 2 ways, and the ways are: number one, you peg your production levels based on the sales. So if sales demand increases, your production levels increases. If sales demand decreases, your production level decreases. That's the first scenario. Second scenario, you have a steady level of production, whether sales increases or not. You have a steady level of production. So if in case your sales drops, you are still producing at that same level, right? But because sales has dropped, you have some inventory that will not be demanded for. You have some products that will not be demanded for because sales has dropped. So those products, you keep it in the warehouse as part of your inventory, so that in times when sales increases, you can supply your customers with that. Very simple. You have production resource planning. A manufacturing company must also plan to obtain resource that it will need to meet the required capacity levels if the company plans to grow. So you need to obtain the resources that it will need each year. It's very, very important. Resource planning involves making decisions about what production technology will be used. What kind of production technology will you use? How much capital equipment will be needed to provide the required capacity? How much capital expenditure will be needed? How many production employees will be required? So here you are talking about resource. The resources you need each year to meet the capacity levels. So what are some of the resources? The capital equipment, the capital expenditure, the employees, and even the technology. These are all resources. The production function will have to liaise with the human resource department to plan recruitment and training requirements over the strategic planning period, because it will need employees to be able to support that capacity. I hope it's making sense. Now let's talk about production cost planning. Production cost measurement is a responsibility of the cost accounting function, but the production function is responsible for planning production in a way that optimizes costs, consistent with other strategic production objectives. So you have cost versus quality. You have cost versus lead time. You have cost versus flexibility. So let's explain. So cost can be possibly reduced by using cheaper materials, right? If you use cheaper materials, your cost reduce. Or if you even use cheap labor, your cost will also reduce. And if your cost reduces in that regard, what happens? Because you are using cheap material, cheap labor, it will have an impact on your quality, right? To have an impact on your quality. So if you want a better quality, you might want to spend more in these areas. So as an entity, as an organization, you should be made, a decision should be made about the quality standards required for production output. Now let's talk about cost versus lead time. Lead time is the time between receiving an order for an item and the time it's actually delivered to the customer. So it's order time versus delivery time. That's the lead time. So if the company wants to minimize production lead times, it will probably need to incur higher costs, because you have to invest into quick delivery and quick turnaround. Very, very key. You need to invest into that. So cost versus lead time is also another factor here. It's also another factor. So if you want to minimize production lead times, it will probably need to incur higher costs. So you see how these decisions impact costs. If you want to increase quality, cost will go up. If you want to decrease quality, cost will go down. If you want to increase lead time, your cost will go down. If you want to decrease lead time, your cost will go up. You have to incur more costs. You have cost versus flexibility. Flexibility is simply the ability to switch easily from one production operation to another. For example, to switch a production line from making one product to making a different product. Like better quality and shorter lead times, greater flexibility is likely to involve higher production costs. If you want flexibility, it will lead to higher production costs. So we'll take a break here, and then in our next video, we'll be talking about the human resource strategy. Thank you for joining. If you haven't subscribed, please hit the subscribe button. It's the red button. Hit the subscribe button and see you in the next video. Thank you.